Welcome back everyone, and the markets have now opened. We're seeing some very interesting trends. We have Google reported earnings, they're up around 3%, Tesla down around 9%, and some very mixed patches right across the board. But the one that we want to uncover today is UnitedHealth, which continues to be on a downward trend. We're talking 3% so far. In fact, if we zoom now year to date, whilst you could be up quite significantly if you had picked some of the stronger performing companies, if you had been heavily invested into UNH at the beginning of the year, you would be down around 43%. Now, not only are they one of the worst performing in the healthcare space, but also one of the worst in the S&P in 2025, although we should say so far. And what's interesting about this, whilst investors are now chasing tech companies with a current P around 30, putting them into the 95th percentile, which is incredibly high. We've talked about this many times before. Both healthcare and energy sectors do look very attractively valued, not only in comparison to other sectors, but also against their own historical averages. We are talking about investor sentiment in extreme greed, where many investors are chasing some very popular names, which valuations are looking incredibly high. Vast majority of them in the tech space, 95th percentile, definitely something we would say just to think about. Now we're covering UNH, which has been down around 4% before the markets open, recovered slightly to negative 2%. So we're going to uncover what is going on with the company, why is it continuing to be down. We've got a few interesting topics to uncover, and also when we get to the valuation, you will be very surprised as the future free cash flow that's already baked into the number. Now, as we said, not only year to date, but over the last year, battered down 48%, nearly wiping out one half of their market cap in the last 12 months. Over the last 10 years, they are up 141%. We're going to uncover how that's fared later on against the S&P and the QQQ. And we also notice not that far off their 52-week low, but a massive distance away from all-time highs around $631. Also worth highlighting, Seeking Alpha and Wall Street giving this a buy rating, both of them out of 5, making it, in their opinion, very attractive to consider. But very importantly, they are due to release their earnings on the 29th, so we are just talking about in a few days' time. Make sure you have notification bell on, you are subscribed. When we get that report, we will be delivering it to your attention ASAP. And just in the last few weeks, in the run up to their earnings, we're actually seeing more and more analysts start to cut their price target. We have Wolf Research lowering it to $330, as well as another analyst down to $340. What makes it interesting, while they continue to cut, the share price is still significantly lower, meaning at a bear case, if you want to believe them, there is still some upside. We also want to draw to your attention that members of Congress over the last few months have been adding this company, not just when it was towards the bottom, but they have been some buys around the $300-400 space. So this does give us a signal that perhaps they know something that we in fact don't. And we also got to see some insider buying not that long ago. We're talking 32 million. In contrast, which is very rare because we typically see the other way around, insider selling $180,000. So lots of insider buys. We can see this was all in Q2 as well. And just to be transparent, we want to show you who the individuals were. We can in fact see on the 10th of June, we have the CEO buying just under 600 shares, costing them $180,000. But also on the 16th of May, we get both CFO and CEO buying quite a significant number of shares. We're talking in the tens of thousands, and in totality, we're talking around $30 million. This is what we would typically say a bullish signal. Remember, insiders buy, they believe the share price will go up over time. And we also want to bring to your attention that whilst not a lot of super investors have released as of now their latest 13F portfolios, those that have come in, we're actually seeing a trend where they're buying or adding shares. We can see 3 of them, and in fact not that many have been released, have been adding shares of UnitedHealth. Now we're going to find this very interesting when they do release. others, notably Warren Buffett, Bill Ackman, to see if any of the bigger names have been adding this very, very hammered down company. And whilst we only have 108 number of buys and ads so far released, we can see number 2 is UnitedHealth. Again, whilst it is tied with Meta Platforms, this is something that could change as more and more super investors release information. But perhaps if we see them maintain the top 2, top 3 position, we will also likely see this in terms of the stock price increase. When investors hear about some bigger names adding companies, that is typically what we know. And purely from a valuation perspective, we're seeing the forward P of 13.6, well below the 5-year average of 20. That in itself, not only an undervaluation signal, but very severe. Although we should say we never look at this in pure isolation. Yield above 3%, one of the highest they've offered, when historically it's sat at 1.4. Again, another undervaluation no. We'll also highlight when looking at the blue tunnel methodology, which gives the parameters of the intrinsic value, there is severe disparity between the current price and the bottom end, another undervaluation signal. Although one thing we don't like is that the blue tunnel has been decreasing over time. Naturally, you want to see the opposite, intrinsic value of companies you're invested in, to move upwards over time. We will, however, point out that it is very rare to see this company in a severely undervalued level. In fact, from 2020 to around 2023, or the beginning of, this company was trading in an overvalued level. Since that point, it wasn't a reasonable signal. We did get one time in 2024, but quite a significant period now in 2025 where the company is looking, as we said, severely undervalued. Also worth reflecting that the sector does sit higher in terms of a PE at around 18, so you're getting a 21% discount against the sector, a 32% discount against their own 5-year average, and for the large part, no matter which metrics you take a look at today, against both sector and in fact their 5-year average, UnitedHealth trading at a massive discount. Now, the company has been hit with bad news after bad news. Not that long ago, the CEO left. We didn't really get a reason as to why. They also suspended their full-year forecast. We then had the Wall Street Journal come out and say that they're under investigation by the DOJ for possible Medicare fraud, something that they came out to dispute. We even had a whistleblower come out and say that they were secretly paying nursing homes to reduce hospital transfers. And they were also accused of pressurizing medical staff to change patient states to do not resuscitate. So pretty much bad news after bad news, something that continues to be on their heads into mid-2025. And now they've come out to say that they are cooperating with the DOJ investigation. This is into their Medicare billing practices, something we heard about not that long ago. And in fact, they've also come out to say they're launching their own third-party review of their business policies as well as their metrics, something that maybe gives faith to investors that they do believe they have followed everything by the law and that ultimately they believe they will come out of this unscathed. And also, for those that don't know, UnitedHealth is America's largest private insurer, and this has been gaining a lot of traction across the media. Anytime we hear news like this for big companies, many outlets will in fact cover it. But we can also see released from the SEC that the company has proactively reached out to the Department of Justice after reviewing media reports about investigations into some of their certain aspects, in particular to the Medicare program, and that they've been complying with formal criminal and civil requests from the department, and ultimately they have full confidence in their practice and commit to working cooperatively with the department through the process. Now, they go on to say a bit more information, which you can pause and read, but ultimately that may be giving some faith to investors that there isn't that much to worry about, but ultimately we won't know more until we see the conclusion, and also earnings next week should shine a little bit more light onto the company, their performance, and any potential issues. Now, very quickly, we can talk about the underlying metrics of UNH. Dividend safety score, for those that are interested, and probably worth knowing given the yield at 3% is a lot higher than their 5-year average, comes to 80 safe. Great to see. We've covered the two severe undervaluation signals, and they just recently, last month, increased the dividend by around 5.2% above inflation. nice to see. Now, if you want to know how they performed in the last recession, well, they actually maintained the dividend, didn't increase, didn't cut. This was the 07-09 Great Recession. They had plus 5% sales. That was above the average of the S&P, which was around negative 12. However, share price itself was negative 63, trading slightly the S&P's negative 55. Now, dividend was disappointing in reality last month, given over the last 5 years and the last 10 years, this has sat at the double-digit rate, 19.3% year on year over the last 10, and we can see they've been increasing the dividend for the last 15 years on a consecutive basis. Now, free cash flow, as always, will draw your attention to that as opposed to the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want. That is very consistently around the mid-20s, 30%, 34% projected over the next 12 months. Good sign that we should hopefully start to see the pickup of some very attractive increases. As we said, 5.2%, a little bit disappointing last month. Free cash flow, though, not disappointing at all, where we get consistent growth for the large part over the last 10 years. Granted, a drop into 2024, expected to continue the upward momentum over the next 12 months. And in terms of sales growth, looking strong, 8% in 2024. More often than not, though, we do see a double-digit increase from UnitedHealth. And we also note, when we do look at their top line, more than doubled over the period. Now, they sometimes return excess cash to investor pockets through share buybacks, not very consistently, but again, nice bonus on top of the dividend. ROIC, in my opinion, one of the most important metrics. We get to see around the mid-teens on a consistent basis, 14% on a trailing 12-month, and that does give us faith management are able to effectively allocate their capital. Margins also good. Whilst it is below the 12%, we'll very briefly highlight that actually it is a lot better than the sector, so no red flag indicator. And free cash flow, as we can see, slightly above 5%, more often than not. Again, looking good. Then we finally get to the net debt to EBITDA. Below 3 is what we want and what we get. And below we get the number of years it would take them to pay off all of their debt net of cash on hand, correlating to balance sheet strength, dividend safety. 1.2 on a trailing 12-month, expected to go a little bit higher, but still well below the maximum. So again, no worries in particular for their balance sheet. Now, growth is really where the company is let down. We see an F, although not really in relation to their revenue, which is 8% last year, projected 9% this year, pretty much around the sector median, not that far off, and only slightly below their historicals, around the 10%. Thing that does let them down though is earnings per share, only projected 5%, sector a lot better at 11%, likewise their 5-year at 13%. But profitability is good, we get an A+, gross margin not as much at 22%, below the sector significantly at 59%, little bit below their 5-year of 24%, but one thing that does look good is their bottom line net income margin, 5.5%, sector burning through cash, -2%, pretty much in line with what they have done on a historical basis, and they generate about 29 billion of cash in the last year than the historical 25 billion, and well above sector, as we just said, burning through around -11 million. Now, in their last earnings, they did report fairly strong numbers, revenue itself up 10% year on year. This is not a small company, it generated just in one quarter over 100 billion. We also got to see some nice efficiencies to their bottom line. It was up 7 percentage points. But they are projecting only one of the next 4 quarters to be growth. In fact, next week they're anticipating a 34% decrease year on year to the EPS. They also have a 75% track record, 3 out of 4 beats, notably missing most recent one by 9 cents. But based on the next full accounting EPS period, forward P is expected to lower to around 12, although bear in mind they did cut the guidance as well as suspending it, so really uncertain about what this number could in fact be. But we will highlight for 2025, year-on-year growth is expected to drop quite significantly by 24%. This is based on 26 analysts and what they anticipate, but they also predict over the next few years double-digit growth to continue for UnitedHealth, and in turn, as we can see over the years, that will lower the forward P, or that is based on the current price today. And for those that like to look back at the historical performances, well, out of the last 2 years, they've beaten every single time on EPS. That is pretty strong, pretty impressive to note. In terms of revenue, they've beaten on 6, they've missed on 2, so again, fairly decent track record. EPS beats though, very impressive to see. And we can also note here, in terms of the surprises, been fairly minimal, highlighting that they pretty much come roughly in line with expectations, so it will be good to see whether they can keep that momentum up into next week. And we should bring to your attention that institutions with their 88% ownership sold $38 billion in just the last year, whilst buying a lot more at $56 billion, so they are net buyers rather than net sellers. However, in Q2, we've actually seen the opposite trend. They've sold twice as much as they have bought, $1.6 billion versus 700 million buys. Now, if you're interested to see their performance against the S&P, perhaps even the QQQ, they're down 46% after reinvesting dividends in the last year. S&P and QQ both have outperformed around 15 and 18 respectively. Same to be seen really over the last 5 years. UNH only up 4%. Remember, that is if you were reinvesting the dividend back into the company. S&P up 97, QQ up 125, and that still holds true if we zoom out even further over the last 10. UNH fairly decent, up 182. Perhaps you wouldn't be worried if you got this over the next 10 years, but just investing in the S&P, you would have been better off, up 202%. QQQ a lot better at 444. Now remember, past performance isn't an indicator of the future, and we'll also quickly compare them against others in the industry. ELV, Humana, Centene, all of these you probably in fact know have been battered down as well, but why we like to do this comparison, understand, is it an isolated issue to the company or in fact to the sector? Well, look at that, the majority are down very significantly, double digit. No surprises, why at the beginning of the episode, we did see this industry as one of the most undervalued. Over the last 5 years, UNH not great, again the same to be seen even in comparison. Others have been better, but also there have been others that have just really given ridiculously bad numbers. And if we zoom out to the last 10 years, they're up 170, actually one of the better performing, but still we have just seen S&P outperform. Now, before we get to our valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic value gets to $390, the average of the 4 that you see on screen. Now, we'll just run through the inputs and outputs so you too can see, but remember, you can always grab a copy of this model by clicking on the pinned comment below. We have Graham's valuation, the EPS, long-term growth rate, AAA corporate bond yield, to give us our first intrinsic value, $230, and also an overvaluation signal. Bear in mind though, we're not looking at any of these models in pure isolation. Then the multiples valuation, companies similar sector and size that we just ran through, average PE, EPS, giving us here another overvalued signal, intrinsically 219 versus market value 284. We then move on to the dividend discount model. Now, we did highlight double-digit growth over the longer term, average 12% for the selected data. Most recent, a bit disappointing, but moving forwards, we have gone for 6%, giving us here our first undervaluation signal. And then we move on to the DCF model, where we've gone 7% moving forwards, average at 14. Using the discount rate as well, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $642, another undervaluation signal. Now, we really must highlight using a reverse DCF model that baked into the numbers right now for UnitedHealth is a decrease of free cash flow year on year of 3%. Do with that information as you wish, but very fascinating. We did think we should bring it to your attention. And as we said, intrinsically, 390, average of the 4 models, grab a copy below. Now, we're not done because we always like to use a margin of safety, selecting 10%, executing on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $351, and then we keep going till it's near the current trading price, and essentially we're seeing today at least 25% up to $292, at 30%, $273. Not quite there yet, so UNH around 25 to 30% MOS. Wall Street themselves projected $380 price target into next year, upside 34%. Let us know in your opinion, do you see this as a buy, hold or avoid? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.